Hey, hi everyone. Welcome to another video in our AI predictive models series. So today we are going to discuss about how mean reversion and statistical arbitrage AI models are being used for trading and for predictive modeling in trading, and what are the important examples, specific examples we'll go through where mean reversion with statistical arbitrage AI models are used in trading. Okay. So, what is mean reversion and statistical arbitrage? So, mean reversion is basically, these strategies. What they do is they assume asset prices deviate temporarily from the historical average, and only to revert back to the historical average. Okay, so historical average is the reference point, and asset prices will only temporarily deviate from this historical average, and eventually they will revert. So, that is what is mean reversion. And statistical arbitrage is applying this mean reverting logic over a pair of pairs. Okay, pairs is basically two stocks. Okay, two stocks or baskets. You can apply it over baskets also of correlated assets. So correlation is if one asset moves, if the correlation coefficient is near to one. If one asset moves up, the other asset also will move up. Like silver and gold has a correlation of one. So similar correlated assets. So we can apply this mean reverting logic over a pair or a basket of correlated assets. And what the strategy will do is it will go long on undervalued assets. Undervalued is something which is below the mean, and overvalued assets or short the overvalued ones, which is above the mean, basically. So that's the basic strategy, and it makes profits eventually when they both revert to the mean. So how we can apply this AI models, for mean reversion is first we need to pair selection. So algorithms can scan for co-integrated assets uh, or stocks, basically, whose spread is statistically mean reverting. And how do you know, this stocks or co-integrated stocks whose spread is mean reverting? Is they use something called as an ADF test. So let's go into that. So co-integration in the context of finance refers to a statistical relationship between two or more series variables. Okay, which where they tend to move together in the long run. So even if they deviate in the short term. So basically, if gold and silver, this is the mean, and if it goes up, gold is going to go up and silver is going down. Eventually, they will come to this mean and go here. Okay, so that is what this co-integration is, where they tend to move together in the long run, but in the short term they can deviate from the mean. And this ADF test, which is an augmented Dickey Fuller test, is a statistical test which is used to determine if a time series is stationary or contains a unit root. Okay, so in the context of co-integration, basically, if we did the ADF test, what we would do is we will just try to find whether it's stationary or there is a unit root. And if we get in the ADF test stationary, that would indicate co-integration. Co-integration basically means two variables or two assets will tend to move together in the long run, even though they're deviating in the short term. Okay, so what we will do is pair selection. So algorithms can scan for these co-integrated assets, which will eventually go in together, uh, and they will find out those assets, co-integrated assets or stocks, which are whose spread is statistically mean reverting through ADF tests. So in the ADF test, it is stationary. Stationary is coming means those two stocks are co-integrated assets. Then we'll use signal generation. We'll do after pair selection. What we will do is use machine learning to trigger trades based on when the spread moves x deviations from the mean. Okay, as I told you, if it goes above the mean, we will short it based on the standard deviation. If it's one or two standard deviation, we will short it because eventually it should come to the mean. And if it goes below the mean, one or two standard deviations, we will go long on it. So that's what these trades will do. So they'll trigger trades when spread moves x deviations from mean, and they will reverse positions when spread toward reverts to the average. So like this is the average. Gold has gone two standard deviations up, and silver has gone two standard deviations down. Then we'll short this position, and we will along this position, and we will exit when both have reverted to the mean. So that's what these algos can do, and machine learning can do. They could trigger trades. They could first identify which pairs are co-integrated assets through ADF test. Then they could trigger trades based on the deviation from the mean. AI enhancements, auto encoders plus reinforcement learning. This models, what they could do is they could learn optimal pairs and positions. So what is the optimal pair which is performing well? What are the positions, position size, and when we need to exit the timing? This it can do adaptively. Neural nets can detect latent spread drivers or nonlinear dependencies. So few of the examples we'll go through, backtest and performance highlights of this mean reversion and the statistical arbitrage models. In the Indian market, sector pair trading. So a project was on NSE stocks across sectors using spread, Z score and Bollinger Bands with ADF selection was done, and this strategy generated market neutral returns. Bollinger method proved more robust. Okay. So Bollinger basically is one standard deviation or two standard deviations from the mean. So I mean, a test was done across sectors using this ADF selection. Then yeah, it generated market neutral returns. In US, Nui Quant, so James Algo, positional mean reversion strategy on stock futures from 2003 to 2020, which achieved 80% net gain in 2020 post cost. There it achieved 80% with modest drawdowns. Okay, on stock futures in from 2003 to 2020. Actually, mean reversion is one of the main strategies of even Renaissance technologies initially when it was founded. After learning algorithms came into picture. Yeah. NSE Nifty 5 minutes in India. So mean reversion strategy using Bollinger Bands again. Okay. So when the stock reaches up to two standard deviations or the upper limit of the Bollinger Band, you short it. At the same time, when it reaches a lower Bollinger Band, you'll take a long position. It returned 89% net return, 62% annualized return with 10% max drawdown. US S&P 500 gaps statistical arbitrage. So mean reverting overnight price gap strategy. 1998 to 2015, some variants delivered 62% annual return post cost, which well above 1.8 buy and hold. US robust lesson, a portfolio of co-integrated S&P 500 pairs returned 35% in 2020 with 85% trade win rate and beating S&P SPY 20% return. So AI-driven enhancements are we can see it auto-encoder reinforcement learning models provide end-to-end optimization, outperforming classical two-stage strategies. Deep reinforcement learning statistical arbitrage on S&P 500 learns adaptive entry, exit, and spread construction. High-dimensional neural net statistical arbitrage across 50 assets shows robustness even in crisis periods. So the performance at a glance. So NSC Nifty 5 minute mean reversion generated 89% net returns and 61.9% per annum, and drawdown just of 10%. Robust short-term gain 62% annually. S&P overnight gap mean reversion 62% annual post cost and 1.8 B&H. High efficacy persisting over 17 years. S&P 500 pair portfolio 2020 35% sharp, greater than the SPY. SPY is an ETF. Okay, so it performed better than that. 85% winning trades outperformed during the crash recovery also. Okay, positional stock future algo James one. 80% gain in 2020 net of cost, okay, after cost basically, and strong single year performance post slippage. AI autoencoder plus reinforcement learning statistical arbitrage models outperforms the classical models. Simplified pipeline with high gross returns. AI reinforcement statistical arbitrage models, adaptive strategies outperform static ones. Fully data-driven optimization across marketing regimes. AI high dimensional neutral statistical arbitrage models, robust returns across 50 assets, works even when co-integration weakens. So why do they work? They have a statistical edge, basically. Okay, as per statistics, normal distribution. Yeah, uh, mean reversion is a phenomena that happens very often, and yeah, generally things that go away from the mean will converge to the mean, and that's a standard. Especially it applies to price a lot. Uh, okay, so that statistical edge is there, and these models capitalize on that pricing inefficiency with discipline and data-driven approaches. AI enhancements, what they do is they help us to identify the spread detection, position sizing, and exit timing. And risk control, market neutral stance helps preserve capital in volatile phases. Portfolio scaling, work this works across baskets and sectors, and greater diversification is there. Okay, caveats and considerations, overfitting risk is there. AI enhanced models can overfit. Rigorous out of sample testing is essential. Okay, and execution costs, high frequency trading includes slippage and brokerage. Strategies tested account for this. Okay, yeah, so basically after costs only, the strategies are giving better results. So the slippage and brokerage costs are included in it. So, but yeah, we need to consider when you do high frequency trading, there is a lot of slippage and brokerage, and the strategies need to be profitable after the slippage and brokerage. So that needs to be tested also, and we need to use some out of sample testing also to avoid overfitting risk. Minor regime breakdown, so pair selections may diverge. Real time monitoring is critical. So you can't just leave it to algos, some real time monitoring is needed. Bottom line is mean reversion and statistical arbitrage strategies enhanced by AI have consistently delivered strong risk adjusted returns across markets, India, US, and timeframes also. And incorporating this deep learning and reinforcement learning optimizes entry exit asset choice and leverage. And with disciplined back testing and cost aware execution, these strategies remain powerful tools for prop as well as quant trading operations. So that's the mean reversion and statistical arbitrage AI trading models for you guys today. And yeah, that's it for today, guys. Thanks everyone. Have a nice day. Bye.